Home prices are slipping across the Carolinas. But for many homeowners, the monthly bill is getting heavier, not lighter. Listings sit longer. Buyers hesitate. Yet insurance premiums, property taxes, and borrowing costs refuse to come down. What once looked like a safe escape, warmer weather, lower taxes, a bigger home, is quietly turning into a financial squeeze. If you own a home here, your leverage is shrinking. If you are trying to sell, the market is no longer waiting for you. And if you are thinking about buying, the risk may not be the price you see, but the costs you don't. So, which Carolina suburbs are already breaking down? And which ones could trap buyers next? To understand why so many Carolina suburbs are sliding at the same time, you have to step back and look at what changed and what didn't. Interest rates flipped faster than most buyers expected. For years, cheap money masked weak fundamentals. Buyers could stretch, investors could carry losses, builders could keep pouring concrete. That era is over. Monthly payments are now calculated in a very different world, and affordability has become a hard ceiling, not a flexible guideline. At the same time, migration patterns have quietly reversed. During the pandemic, the Carolinas absorbed waves of newcomers chasing space, safety, and a lower cost of living. Builders and investors treated that demand as permanent. Subdivisions multiplied, permits surged, entire neighborhoods were planned around the assumption that tomorrow's buyers would always arrive. But demand cooled, first slowly, then suddenly. Remote work normalized. Corporate relocation slowed. Households that moved once are not rushing to move again at today's rates. The pipeline of new buyers narrowed just as supply peaked. That mismatch is now showing up in longer days on market, swelling inventory, and price reductions that no longer feel temporary or strategic. What makes this cycle different from past corrections is not just falling prices, it's the cost of ownership. Even as home values soften, the monthly burden keeps climbing. Insurance premiums rise. Property taxes reset higher. Maintenance costs inflate. And lenders are far less forgiving than they were during the last boom. Before we dive into the 7 real stories that reveal how this plays out on the ground, take a moment to protect your future self. If you want clear, data-driven housing analysis, not sales pitches, tap like so this reaches others facing the same decisions. Subscribe to the channel and turn on notifications because each of the next 7 places tells a different cautionary story, and missing one could mean missing the warning sign closest to home. Investors are already reacting. Many depended on rent growth to justify aggressive purchases. Now, vacancies are creeping up, incentives are back, and margins are thinning. When investors stop buying or start exiting, the floor under prices weakens fast. This is the backdrop for the 7 Carolina suburbs we're about to examine. Same region, same interest rates, same national economy. So why are some places cracking first, and which ones are next? 7. Goose Creek. For years. Now, Goose Creek played a very specific role in the Charleston housing ecosystem. It was the fallback option. When buyers were priced out of downtown Charleston or the coastal communities, they came here looking for something attainable. Smaller homes, modest yards, monthly payments that still looked manageable. During the boom, that formula worked, until it didn't. Builders flooded the market with near-identical subdivisions designed for first-time buyers. When mortgage rates were low and job confidence felt solid, demand absorbed the supply. But as borrowing costs climbed, the buyer pool Goose Creek depends on began to shrink fast. Today, listings sit longer. Price reductions are no longer a red flag. They're expected. Active inventory has jumped sharply compared to just a year ago, while pending sales have slowed. Yes, the math no longer works for many households who once qualified comfortably but now fall short under stricter lending standards and higher monthly payments. Early stress signals are appearing. Foreclosure activity has ticked up, a warning sign that some owners are already struggling to keep up. Median prices, which once rose steadily, have begun to slip on a quarter-by-quarter basis. At the same time, new construction communities are offering aggressive incentives. Closing cost credits, rate buydowns, and upgrades simply to move finished homes. That creates a second problem. Recent buyers trying to resell are now competing directly with brand new homes priced more attractively. Their leverage evaporates overnight. Rental demand, once seen as a safety net, is also weakening. Vacancies are creeping higher, and rent growth is no longer strong enough to bail out expensive purchases. Investors who once treated Goose Creek as a reliable entry-level rental market are pulling back. Goose Creek isn't collapsing because it failed. It's struggling because it was built for a buyer who no longer exists at today's rates. And if this is happening here, at the entry level, what happens when the pressure moves up the price ladder? 6. Wake Forest. Wake Forest was one of the clearest winners of the remote work boom. Just north of Raleigh, it offered tree-lined streets, new schools, and the promise of a quieter life without giving up access to a growing job market. Buyers arrived from more expensive states, paid aggressively, and rarely negotiated. For a while, demand looked endless. Builders responded the only way markets do in a frenzy. They built fast and built big. New subdivisions rolled out phase after phase. Permits surged. Anything with modern finishes and a short commute into the triangle moved quickly, often above asking. That speed is gone. Today, for sale signs stay planted in the same yards week after week. Inventory has risen sharply compared to last year, and days on market have stretched far beyond the pace sellers were conditioned to expect. A growing share of listings now shows at least one price cut, and some homes quietly return to the market after failing to sell the first time. The strain is visible on the development side as well. Builders are slowing future phases, leaving partially finished streets and empty lots as reminders of how abruptly the rush ended. New permits have cooled, not because land disappeared, but because buyers did. The rental backstop is weakening too. Property managers report vacancies creeping higher, which removes the safety valve many owners assumed would protect them. When rents flatten and mortgage payments stay high, holding becomes harder to justify. Wake Forest's problem is not a lack of appeal, it's timing. Prices here were set during a moment that no longer exists. Ultra-low rates, migration urgency, and unchecked optimism. The market has moved on, but expectations haven't caught up yet. Sellers are waiting for yesterday's buyers. Buyers are negotiating for tomorrow's prices. So what happens when patience runs out? And the correction deepens in places that still look perfect from the outside? 5. Indian Trail. Indian Trail was sold as balance. More space than Charlotte. On quieter streets. Family-friendly neighborhoods. And for a brief window, prices that still felt reachable. That balance didn't last. Over the past few years, home values here climbed faster than local incomes could reasonably support. During the low-rate era, the gap was easy to ignore. Buyers stretched, lenders approved. Monthly payments looked manageable on paper. Now the math is exposed. As mortgage rates reset higher, many local buyers simply no longer qualify at the prices sellers are asking. The result is visible across the market. Inventory has multiplied compared to last year. Completed sales are down. Homes that once moved in days now sit for weeks, sometimes longer, without serious interest. Price resistance has finally cracked. Median prices that held stubbornly high through the early slowdown are now bending lower quarter by quarter. To keep deals alive, sellers are offering concessions that were unthinkable just a short time ago. Paying closing costs, buying down interest rates, or absorbing inspection repairs outright. Behind the listings, stress is building. Days on market continue to climb. Pre-foreclosure activity has increased in certain pockets, a signal that some households are stretched thin after buying near the top. Investor activity, once a meaningful source of demand, has fallen sharply as returns become harder to justify. Even showing traffic tells the story. Buyers are still looking, but they are slower, more selective, and far less willing to chase. Indian Trail didn't lose its appeal overnight. It lost its affordability. And when prices detach from what local incomes can support, the correction doesn't arrive all at once. It grinds. If this is what affordability stress looks like on Charlotte's outer edge, what happens in the markets that relied even more heavily on speculative demand? 4. Gastonia. Gastonia has always lived in Charlotte's shadow. When prices inside the city surged, this was the pressure valve. The last affordable option for buyers who still needed access to the metro. Older homes. Renovation potential. A chance to get in before prices caught up. For a moment, that story worked. As Charlotte grew more expensive, flippers and small investors flooded into Gastonia. Renovations multiplied. Listings moved quickly enough to justify the risk. But that demand was never as deep as it looked. And once conditions tightened, it thinned out fast. Now the numbers tell a different story. Pending sales have dropped sharply, signaling fewer deals being agreed to before they ever close. Inventory has surged compared to a year ago, and homes are sitting on the market far longer than sellers expected. Average days on market have climbed into territory that signals hesitation, not negotiation. Price behavior has shifted too. Median sale prices are no longer just flattening, they are drifting lower. Distressed transactions, once nearly invisible here, are beginning to reappear. Bank-owned homes and short sales are still a small share of the market, but their return marks a clear change in tone. The rental side offers no relief. Rent growth has stalled, and in some segments has slipped, squeezing landlords who bought with little margin for error. Many of the investors who once acted as a backstop for demand are gone, leaving owner-occupants to absorb inventory they cannot comfortably afford. Gastonia matters because it moves first. Historically, when pressure builds in a metro area, it shows up here before it reaches more expensive suburbs. This city was the final stop for stretched buyers, which makes it the first place where the stress becomes visible. If this market is already sliding, the question isn't whether the risk spreads outward, it's how far it goes and how quickly. 3. Kannapolis. For several years, Kannapolis looked like a success story powered by scale. Large investors moved in early. Single-family homes were acquired in bulk. Renovations followed, rents rose, prices held firm. For a while, institutional money acted as a quiet guarantee that values would keep climbing. That support is fading. Today, the buyers who once set the floor here are stepping back. Investor purchases have dropped sharply compared to previous years, and some of the same players who built portfolios are now testing the exits. When that kind of demand disappears, the market has to stand on something else: local incomes and organic buyers. So far, that transition has been rough. Inventory has grown quickly. A rising share of active listings now shows price reductions, sometimes more than once. Median sale prices have stopped climbing and are beginning to edge lower. Days on market have stretched well beyond what sellers were trained to expect during the boom. Vacant homes are becoming more common. Some owners would rather leave a property empty than cut the price or rent to where demand actually is. New construction plans are being trimmed, permits are down, future phases are being delayed while builders wait for clarity that hasn't arrived. Signs of financial strain are appearing beneath the surface. Foreclosure rates have crept above national averages. Delinquencies are rising. These are early indicators, but they tend to show up first in markets where leverage was high and investor concentration was heavy. Kannapolis exposes a fragile truth. When Wall Street-scale money steps away, prices don't float. They recalibrate, often faster than expected. The market that once relied on external capital now has to survive on local wages and cautious buyers. If this is what happens when investors pull back, what does it look like in places where prices are even higher and carrying costs are even heavier? 2. Mount Pleasant. Mount Pleasant has long been treated as untouchable. Coastal access, manicured neighborhoods, strong schools, an image of stability that made buyers believe prices here would always hold. But arithmetic eventually overrides reputation. Home prices in Mount Pleasant climbed into territory that already demanded high incomes. What changed wasn't just price, it was the total cost of staying. Insurance premiums along the coast surged as storm risk was reassessed. Property taxes reset higher. Borrowing costs climbed. Yet the monthly bill now looks very different than it did even a few years ago. The effect is showing up first at the top. Inventory for higher-end homes has grown noticeably. Million-dollar-plus properties are taking far longer to sell, with days on market stretching toward 3 months or more in many cases. Sellers who once expected quick, confident buyers are now cutting prices, sometimes by 6 figures, just to attract serious interest. Luxury buyers are pushing back. The ratio between sale price and original list price has slipped below what this market was accustomed to. Jumbo loan activity has slowed as lenders tighten standards, and affluent buyers become more cautious about taking on large, long-term obligations in an uncertain market. New high-end construction is reacting too. Custom builds are pausing. Now planned projects are being delayed. Builders are no longer confident that yesterday's demand still exists at today's numbers. Mount Pleasant's slowdown isn't about distress yet. It's about limits. Even wealthy buyers have a breaking point. When ongoing costs rise faster than perceived value, patience disappears. And once confidence cracks at the top of the market, the pressure rarely stays contained there. If one of the Carolinas' most prestigious suburbs is feeling resistance, what does that mean for the places without Mount Pleasant's safety net? 1. North Charleston. North Charleston sits at the most fragile point in the regional housing chain. Historically shaped by industry, shipping, and working-class neighborhoods, it became the pressure release valve during the boom. And when buyers were priced out of Charleston's historic core and coastal suburbs, they came here because inventory still existed, and prices looked reachable. That reach is now proving deceptive. Today, North Charleston carries the combined weight of every risk we've seen so far, and then some. Inventory is elevated. Mortgage rates remain restrictive. Insurance costs are climbing. And unlike more polished suburbs, this market also contends with persistent concerns around crime and job sensitivity to economic slowdowns. The data reflects that strain clearly. Prices here are not just stalling, they are falling faster than in much of the surrounding region. A majority of listings sit on the market for 2 months or longer without serious offers. The gap between asking prices and final sale prices has widened, pushing sale-to-list ratios into territory that signals weakening seller confidence. Foreclosure filings have risen sharply, placing North Charleston among the most stressed pockets of the broader coastal market. Investor activity, once a crucial source of demand, has nearly vanished. Flippers and landlords who once absorbed inventory are stepping away as risk overtakes reward. Rental stress is part of the picture as well. Vacancies are rising. Evictions are more common. For many households, higher housing costs collide with limited wage growth, tightening financial pressure from both sides. What makes North Charleston critical isn't just what's happening here, it's what it represents. This is what a full correction looks like when too many vulnerabilities stack up at once. Fewer buyers, more distress, rising caution, and accelerating downward pressure on prices. For most people, this is not a market to bet on a quick rebound. It's the market you study carefully, because it shows how fast stability can unravel when conditions turn. Across these 7 Carolina suburbs, the pattern is no longer subtle. Different locations, different price points, different buyer profiles. Yet the same pressure keeps surfacing. This cycle wasn't caused by one mistake. It was built from a sequence of assumptions that all broke at once. Buyers believed low rates would last. Investors trusted rent growth to cover any risk. Builders assumed migration was permanent. Sellers became convinced that prices only moved in one direction. For a while, those beliefs reinforced each other. Then the conditions changed, and the structure began to strain. What makes this moment dangerous is not just falling prices, it's the mismatch between expectations and reality. Many homeowners are sitting on properties priced for yesterday's market, carrying monthly costs designed for a world that no longer exists. Insurance, taxes, and financing costs remain elevated, even as leverage shifts toward buyers. In places like Goose Creek and Indian Trail, affordability snapped first. In Gastonia and Kannapolis, investor demand vanished. In Mount Pleasant, even affluent buyers began to push back. And in North Charleston, every vulnerability converged at once. This is how corrections deepen, not through panic, but through fatigue. Sellers wait, buyers hesitate. Inventory builds. Price cuts spread quietly from one neighborhood to the next. So the real question isn't whether these markets will bounce back quickly. It's whether the growth narrative that powered the last decade still exists at all. If you live in one of these areas, the most important move may not be buying or selling, but understanding where you actually stand in the cycle. And if you're watching from elsewhere, pay attention. These suburbs don't fail in isolation. They tend to signal what's coming next. If this kind of grounded, data-driven housing analysis helps you think more clearly about your own decisions, take a moment to like the video so it reaches others who need it. Subscribe and turn on notifications to follow the next real stories before the headlines catch up. Because in housing, the warning signs always appear somewhere first.